Looking to save and invest for your children? With a £9,000 yearly allowance for junior ISAs, you can squirrel some money away to use for either stock market investing in a stocks and shares junior ISA or cash savings in a cash junior ISA. In this video, we pit them against each other and go 5 rounds to decide which might be best for your kids. Hi, I'm Marcus De Silva. I've been in the investment industry for nearly 15 years, teaching DIY investors simple strategies that help them invest sensibly for a better future. There's lots of podcast conversations and tutorials on the Steps to Investing YouTube channel. Check them out and don't forget to subscribe and turn on notifications for all of the latest. Now, particularly for all you new parents out there, but also grandparents too, today's episode is about saving and investing for your children's futures. We know having kids is a pricey endeavour, and that's not just the schooling, the clothing, the Taylor Swift albums. What about when they become young adults and go off into the big bad world? If there's university on the horizon, tuition fees at the moment can reach £9,250 per year, which is almost £28,000 for a 3-year degree. And that's before you even get to accommodation and living expenses. If it's their first home, it's worth reflecting that the average price in the UK has nearly doubled from around £150,000 20 or so years ago to around £290,000 today. Where are prices going to be in another couple of decades from now? Seeing this, the government has created a tax-efficient way to save and invest in the futures of young people, the Junior ISA. There are 2 types, the Cash Junior ISA and the Stocks and Shares Junior ISA. Each year, you can contribute up to £9,000 into them, which is separate from your own £20,000 yearly adult ISA allowance, and you may open both and spread your money across them however you wish. So might it be worth it? Well, big online investment broker AJ Bell did some calculations, and what they show is the extraordinary power of compounding on your investment returns over time. So if you put the full amount of £9,000 in each year, 18 years, then your total contributions would be £162,000. If you then received a relatively conservative 4% returns after fees over that 18 years, then what you would end up with is more than £240,000. That's about 50% more than you put in. Of course, there are no guarantees when it comes to stock market investing, and any kind of stock market investment comes with risk. Here's what you would have with different contributions growing at the same rate after 18 years. What they show is that saving and investing is likely to be worth the small effort required to get going, which is what our kids campaign in association with Columbia Threadneedle is all about. And there are 2 options to choose from, cash or stock market investments. We know what that means. Let's put them in the ring, strap up those gloves, and go 5 rounds to decide which might be best for your kids.
Round 1, tax treatment.
The big bruising attribute of ISAs is that they are free of all taxes that might be applied on your savings and investments. Within cash ISAs, this means protecting you from taxes on interest received above your personal savings allowance and starting rate for savings. Within stocks and shares ISAs, you're protected from capital gains tax, CGT, but also taxes on income from shares, known as dividends, and taxes on income from bonds. No taxes means more of your contributions stay in your child's pot, growing and compounding over time. And given the government's tendency to kick taxes around like a political football, you are also protected from any changes a future chancellor may dream up down the line. They're still circling each other at the end of round 1. It's neck and neck.
Round 2, low risk.
Now, some of you may be a little risk averse, especially when it comes to saving for your children. In reality, when it comes to investing, there is always a risk versus reward trade-off. The more risk you are willing to take, the higher the potential returns, but also the greater the possible losses. Cash ISA savings come with far fewer risks, not to mention some of the best saving rates we've seen in over a decade. Not only that, the government's Financial Services Compensation Scheme protects you in case your bank goes bust, up to £85,000 per institution. Cash ISAs have landed a few chin blows on low risk and take round 2.
Round 3, potential for long-term returns.
Higher risk means potentially better returns. But how do you manage those stock market risks that you're taking? Well, time is definitely your friend in this respect. Longer investing timeframes reduce the chances of a loss. Barclays actually examined stock markets going all the way back to 1891, and they found that shares beat cash 91% of the time over 10-year rolling periods. Of course, when investing for your children, you may have up to 18 years. Remember though, individual shares are very risky as you are tied to the fate of a single company. Ready-made portfolios such as trackers, funds, and investment trusts are one way to diversify some of these quite specific risks while still exposing your investments to the overall power of potential stock market returns. Stocks and shares ISAs are fighting back and win round 3.
Round 4, inflation.
The higher inflation we've experienced in the last couple of years has actually been a killer for the returns of pretty much any asset. But it has meant that interest rates and therefore savings rates have risen in lockstep. The problem is though, for most of this time, they have still remained below the rate of inflation, which means the value of cash has actually been going backwards. Shares have struggled in this environment too, but broadly they tend to fare better in inflationary environments, given that some companies are able to hike their prices in line with inflation, which can boost share prices. What's more, with inflation broadly falling, a rate cut may be on the table this year in the UK. A wealth manager called Quilter looked back through history all the way to 1975 and found that out of the last 14 times rates were cut following a series of rises, the one-year returns that followed in 11 of those cases were fairly strong as pressure was released on the economy. Who knows where inflation may go in the future, but stocks and shares ISAs win round 4.
Round 5, easy access.
Now, don't get me wrong, both cash and stocks and shares junior ISAs have no difference in the restrictions placed upon them. Parents can contribute to accounts and control them, but the money is legally their child's and will be accessible to them at aged 18. If you want more control over when the money can be accessed, then you may need to look at regular dealing accounts and foregoing any tax advantages. But at 18, there's also a more practical difference between the two ISAs. The value of cash is steady, whereas stock market investments are volatile and may go through periods where they're in the black and other periods where they're in the red. Selling in the red must be sidestepped if crystallizing losses is to be avoided, which means there are times when accessing those investments may be inopportune, with cash ISAs sneaking in an uppercut in the last few seconds. They take the final round. It goes down to the judges and the results are in. It's a draw. Now, of course, it's dependent on your individual circumstances, but often, as with most approaches to investing, it's best to have a foot in both camps. Cash ISAs tend to be a smoother ride, whereas stocks and shares have greater potential for stronger long-term returns, given the window that you have before your children become adults. For more in our kids campaign, check out the playlist in the Steps to Investing YouTube channel. Remember, when investing, your capital is at risk and you may not get back the original amount that you put in.